Hi, welcome back. In this session, I'd like to talk about country risk. Now, what is country risk? There was a time not that long ago when we did not have to care about the risk of any market outside our own. We were mostly domestic investors investing in companies that invested only domestically. But things have changed. Things have changed over the last 3 decades. In fact, the globalization genie, if you think you're going to put it back in the bottle, is out of the bottle. Investors have become more global in their portfolios. They hold stocks there is still a bias, but they hold stocks that are outside their markets. And even if they hold just domestic companies, let's face it, there are no more domestic companies. Companies are global. They get their revenues increasingly from outside domestic markets. Put differently, there is no place to hide from assessing country risk. To invest, you need to understand not just what the risk is in your country, but what the risk looks like in other countries and what kind of reward you get in those countries. That has been the focus of my country risk updates that I've done twice every year for pretty much the last 25 years. So let's set up the fundamentals of country risk. As I see it, there are 3 reasons why risk varies across countries, and these are the 3 fundamentals. The first is that the existence of corruption and bribery can change your operating modem and costs in different countries. So the prevalence of corruption varies across countries. The second is the exposure to physical violence, either from war or terrorism, can also vary across countries, and that can affect your operations and your business value. And finally, the legal system that protects your rights, that share of ownership you have, can also vary across countries. So let's start off by looking at those 3 fundamentals. Let's first start look at corruption and bribery. The way I see it, corruption is a hidden tax. When you have to pay or grease the hands of every layer of government along the way, you are in fact paying a tax, but that tax doesn't show up as taxes in your financial statement. It just shows up as additional expenses. So it is a hidden tax, and in much of the world, since it's not legal for companies to pay bribes, at least from the developed markets, they have to hide these costs elsewhere. Within these countries which have a lot of corruption though, this can become a competitive advantage that companies that are particularly good at playing the corruption game, and they tend to be corrupt companies, have a competitive advantage over more straight-laced or legal companies that don't like to break the rules. So let's look at how corruption varies across the world. This is my heat map of corruption around the world. The green are the less corrupt countries, and the more red you go, the more corrupt the countries, and the yellow fall right in the middle. You can see that Africa, if you were breaking down by region, Africa is the biggest problem, but you can see big chunks of Eastern Europe and Russia also have the same problem. Asia is improving, but it's still in the yellow zone. Europe and North America tend to be the least corrupt markets. And you also have a list, if you look at towards the top left, of the least corrupt and the most corrupt. And the least corrupt markets tend to be Northern European. There are a couple of Asian markets that make it on there. And on the most corrupt markets, you see a lot of African countries. Let's move on now to violence. Why do we care? For obvious reasons. Running a business when you're surrounded by violence is very expensive. You got everything. Your day-to-day business becomes much more expensive to do. It shows up as higher expenses and lower profits. In extreme cases, when you have a lot of corruption, it can put your entire business at risk. You face truncation risk. Your business might cease to exist. Again, let's look at the difference in violence around the world, the green being the least violent and the red being the most violent. Again, you can see there are some surprises here. While Africa and Eastern Europe tend to be, and portion of the Middle East are among the most violent, that's no surprise. You do see parts of the world that you did not think of as being more violent, like the United States and the UK, showing up as potentially more violent than you thought they were. So basically, violence varies widely around the world, and that can affect your business. Finally, let's look at legal protection. Why do we care? When we value a share of ownership in a business, we assume that that share of ownership is protected. Protected by whom? By courts, by the legal system. So if you live in a market where your rights are not protected, or where the legal system takes forever, because it's not just how efficient the legal system is protecting rights, how timely it is. If you live in a system where you don't get that protection, the value of your ownership stake became a lot smaller. So in countries or parts of the world where ownership rights are not protected, you could argue that your value for a particular share of a business is going to be worth a lot less. Again, this is an index of legal protection around the world. The green again is the best protection. You can see that North America and Australia have among the best protection. The red is the least protection. The yellow falls right in the middle. Again, you can see wide variations around the world. So if I were to sum up, there are differences in corruption, differences in violence, differences in legal protection around the world. And you say, I would like a composite measure. Me too. And in fact, when you look at composite risk measures, there are quite a few services that do it. The World Bank does it. I actually use a service called Political Risk Service. It's a Europe-based service that assesses composite risk by country. I just use the composite risk scores, and again, the lower the risk score, the higher the risk of a country, and the higher the score, the safer the country is. So if you look again at the word, you can see the breakdown correlates very much with what you saw on the other three maps. Africa remains a hotbed of risk. Asia is improving, but it's still in the middle. Europe and North America tend to be less risky. So at this stage, we have measures of overall country risk. Now, from the perspective of investing, though, we have to convert these risk measures into numbers. And the numbers that have been around the longest are measures of default risk. And there are two broad measures of default risk that have been used for countries. The first is sovereign ratings. And just as companies have been rated by ratings agencies like S&P and Moody's, they've been rating sovereigns for a few decades now. And in fact, they've been adding more and more countries to the mix. If you combine the sovereign ratings from Moody's and S&P, about 141 countries in the middle of 2018 had a sovereign rating. And those ratings look just like corporate ratings. They go from AAA, which is the highest rating you can have for a sovereign, down to D, being in default. You can also have market-based measures. The market-based measures can either come from looking at government bonds issued by a country, and this works only if your government bonds are issued in either dollars or euros, where there is a default-free bond that you can compare to. So a Brazilian dollar denominated bond can be compared to a US dollar denominated bond, the T-bond, to get a measure of default risk. Or better still, in the last decade, you've got the sovereign CDS market, where you buy insurance against default risk and get a measure of the default spread by looking at what you have to pay. So let's look at how the world looks from a sovereign rating picture. Again, if you look at these ratings, you should not be surprised that there is a high correlation between what you see in these ratings and what you saw in the previous pictures. The red again reflects the lowest rated countries. The green is the highest rated countries. And there are areas of the world where you get some surprises. In the Middle East, for instance, you get shades of green. Saudi Arabia, for instance, has a high rating. And that is reflective of one of the weaknesses of focusing on default risk. Saudi Arabia does not have a great deal of default risk because it's an oil-rich country with a small population and not very much debt. You're not afraid of default, but you have a lot of political risk. So default risk is a narrower measure of risk, but you can at least see that it gives you a way of getting started in the risk in countries. Sovereign CDS spreads are market-based measures. One of the critiques of ratings agencies is that they're slow to the game. They're slow to change. They're slow to learn. If you look at market-based measures, they're quicker to respond to crises. So here again, the highest sovereign CDS spreads go with the highest default risk, and they're shaded in red. The lowest sovereign CDS spreads go on the green, and they're the least risky, and the yellow fall right in the middle. Now, again, notice that there's a fairly high degree of correlation here between the sovereign CDS spreads and ratings, but there are some countries where there is a disconnect, and that disconnect might reflect the fact that recent events have increased the risk of the country. So the market-based spread will reflect it, but the ratings might not. Now let's talk about equity risk. If you're lending to a company, if you're buying bonds in a company, what do you care about? In a company, you care about default risk. But if you're investing in the equity of a company, you care about equity risk, residual risk, which is much broader than just default risk. So when you go from default risk of a country to equity risk in a country, you're looking at a much broader spectrum of risk. The question is, how do you measure that equity risk? So let me start off with two basic propositions on equity risk in countries. The first is a very broad one. One of the basic tenets of modern portfolio theory is if country risk is diversifiable and investors are globally diversified, you will not get rewarded for country risk, which effectively means you can use the same equity risk premium around the world. In fact, this was the argument that many consultants and companies used in the 1980s to use one cost of equity around the world. But this will work only if country risk is not fully diversifiable. Okay? But if country risk is fully diversifiable, if country risk is not fully diversifiable, either because the correlation across countries is high or investors are not global, then there will be differences in equity risk premium across countries. And I think over the last couple of decades, what we've noticed is an increase in default in correlation across countries. So I'm going to argue that increasingly there's an argument to be made that equity risk premium should vary across countries. Here's my second proposition, though. The risk that a company faces should not come from where it's incorporated, it should come from where it does business. So just because you're a US company, I cannot attach the US equity risk premium to you if you get 80% of your revenues or you produce 80% of your goods in Brazil. So those are the two propositions I'm going to build on. And first, I'm going to try to compute equity risk premiums for countries because I truly believe that country risk is not fully diversifiable. Partially maybe, but not fully. So on July 1st of 2018, here's how I estimated equity risk premiums for individual countries. I started by estimating an equity risk premium for the US. I do this at the start of every month by doing an implied equity risk premium for the S&P 500. At the start of July 2018, that number was 5.37%. I call that my mature market premium. Then I look up the sovereign rating for your country. Remember, there are 141 countries which have sovereign ratings. I use that rating to come up with a default spread for your country. So if you're a AAA rated country, you have no default spread. I give you the US equity risk premium. If you're a AA, single A, triple B, there's a default spread, but I don't use that default spread as my measure of additional country risk. I scale it up to reflect the fact that equity is usually riskier than bonds, and I measure that risk by looking at the relative equity market volatility, by dividing the standard deviation of emerging market equity by emerging market bonds, and I come up with a ratio of 1.22 in July 2018. So to give you an example, if you have a country with a default spread of 2%, I multiply that by 1.22 to come up with 2.44%. That becomes my additional equity risk premium in that country. I add it to the 5.37% I have for the US. I have a total risk premium for the country. I do this for every rated country. There are about 24 countries which don't have sovereign ratings. Countries like Syria, North Korea, no surprise there. But for these countries, I have a PRS score. And here's how I cheat. I look for other countries with roughly the same PRS scores which have a rating and an equity risk premium. And I attach the equity risk premium of those countries to Syria and to North Korea. You're saying that's cheating? Well, that's the best I could do. I would now have equity risk premiums for about 160 plus countries. And here's what the world looks like to me from an equity risk premium perspective. Again, remember, if you're AAA rated, I give you 5.37%. If you're lower rated, your premium gets higher, and the lower your rating, the higher the premium becomes. Now, how does this play out in valuation? If I'm valuing a company, I have to measure your exposure based on operations. And one of the simplest measures of operations is revenues. For a company like Coca-Cola, for instance, which breaks its revenues down regionally, the equity risk premium I would use is not the equity risk premium for the US, even though it's a US company. It's a weighted average equity risk premium of the regions of the world it operates in. These are weighted average equity risk premiums for each region based upon the GDP of each country within that region. So I have a 6.9% equity risk premium, much higher than the 5.37%. Now, you're saying, why revenues? Well, for companies like Coca-Cola, that's where I think the risk comes from. But if you're a natural resource company or a big manufacturing company, you could argue that your risk comes from where you do your production. So for Royal Dutch, for instance, I estimate an equity risk premium by looking at the barrels of oil and by the oil and gas production they have by regions of the world. Again, I break it down by percent. I take a weighted average equity risk premium. The weighted average equity risk premium I have for Royal Dutch, even though it's a UK company, is 8.04%. Emerging market levels because it gets so much of its oil in the riskiest parts of the world. So from a valuation perspective, that's how equity risk shows up, is in the equity risk premium. You don't have to adjust betas or risk-free rates. Those are different issues. If you're doing capital budgeting, here's how risk premiums show up. Let's say, go back to Coca-Cola. Let's say it's looking at 3 projects, one in Nigeria, one in Chile, and one in the US. To get my equity risk premium for each of these, here's what I do. For the Nigerian project, and assume these are all soft drink projects or in the same business, and they're all in US dollars because I want to keep them comparable. So the risk-free rate and beta I use is the same for all 3 projects. 3% is my risk-free rate, 0.80 is my beta. The risk premiums are different. For Nigeria, my risk premium is 13.15%. Why? Because Nigeria is a low rating and a high risk premium. Chile is a much safer country. The risk premium is 6.22%. And for the US, I use the US equity risk premium. It says Canada there, but it's the US of 5.37%. My cost of equity that I use in capital budgeting varies depending on what part of the world I invest in. 13.5% in Nigeria, down to 7.3% in the US. Unfortunately, the standard practice that many multinationals seem to use is to compute one cost of equity, often based on the country of incorporation, which for Coca-Cola would be the US, and used it around the world. You're saying, what's wrong with that? Well, you're going to be subsidizing investments in your riskiest parts of the world. You'll be over-investing in Nigeria and under-investing in safe parts of the world if you do this. So try not to cross-subsidize, and the best way to do that is to make sure that you are adjusting for where you're investing. Of course, if I'm looking at a company like Siemens, which is in many businesses in many countries, the problem gets even more complicated, because to estimate the hurdle rate for a project, I need to first specify what currency I want to do the hurdle rate in. That'll define my risk-free rate, what business the investment is going to be in. That'll determine my beta, and what country I'm investing in. That'll give me my cost of equity that I will use in my capital budgeting. Now you're saying, I do just pricing, P ratios and EV to EBITDA multiples. I don't care about any of this stuff. Don't you? You should, right? Because if you accept my proposition that equity risk varies across countries, you should expect to see it in your PE ratios and EV to EBITDA multiples, with riskier countries having companies trading at lower values. So if you're comparing companies across multiple markets, and some of them are risky and some of them are safe, if you're not careful, you will be over investing in companies in the riskiest markets because they will look cheap to you. So if you're looking across Latin America, Venezuela, Argentina, and Ecuadorian companies are going to look cheap relative to Chilean, Colombian companies. So you need to control for country risk when you compare across, and even if you stay within a market. Remember what you saw with Coca-Cola and Royal Dutch. Now, you might still get big differences in exposure to emerging market risk as you look across companies. So let's review. Country risk is a problem that we all have to face frontally. It's not difficult, but it does require that we be careful. We can no longer just look at a company based on where it's incorporated. We have to look at where it does business, and we have to keep track of what's going on in the rest of the world. Thank you very much for listening, and I hope you found this useful.